Reversal patterns in candlestick charts are important technical analysis formations that traders use to identify possible changes in the direction of price movement. These patterns do not guarantee that a trend will reverse, but they can provide useful signals when combined with market structure, support and resistance, volume, and other indicators. A bullish reversal generally appears after a declining trend and suggests that buyers may be gaining control, while a bearish reversal develops after an upward trend and indicates that selling pressure may be increasing. Some of the most widely recognized bullish patterns include the hammer, bullish engulfing, morning star, and piercing line. A hammer has a small body and a long lower wick, showing that sellers pushed price lower, but buyers recovered much of the decline. A bullish engulfing pattern occurs when a larger bullish candle completely covers the previous bearish candle, suggesting increasing buying pressure. The morning star is a three-candle formation that can indicate a transition from bearish to bullish conditions. On the bearish side, common patterns include the shooting star, bearish engulfing, evening star, and dark cloud cover. A shooting star has a small body with a long upper wick and may indicate rejection of higher prices. A bearish engulfing pattern occurs when a large bearish candle completely covers the preceding bullish candle, potentially signaling stronger selling pressure. Traders should avoid treating individual candlestick formations as automatic entry signals because market conditions can produce false reversals. Confirmation is especially important. For example, a trader may wait for the candle following a reversal formation to move in the expected direction, or look for a break of a nearby support or resistance level. Trend context is equally important because the same candlestick can have different meanings depending on where it appears on a chart. A hammer near established support after a prolonged decline may be more meaningful than a hammer appearing randomly in the middle of a sideways market. Similarly, a shooting star near major resistance can provide stronger context than one appearing during an established uptrend without additional confirmation. Traders can also combine reversal patterns with indicators such as RSI, MACD, moving averages, or volume analysis to strengthen their overall assessment. In binary trading, where the outcome depends on whether price finishes above or below a predetermined level at expiration, timing and confirmation become particularly important. Traders should therefore consider the expiry period, market volatility, and strength of the reversal before entering a position. Risk management should remain central because even well-known patterns can fail unexpectedly. Using a demo account, maintaining detailed trade records, and testing patterns across historical market conditions can help traders understand how frequently particular setups succeed or fail. Ultimately, reversal patterns are best viewed as probability-based tools rather than guaranteed predictors. Their effectiveness comes from interpreting the entire market context, waiting for confirmation, combining complementary analysis techniques, and maintaining disciplined risk controls instead of relying on a single candlestick formation to make trading decisions.